Why am I specifically aiming for this price leg? Why am I only looking at this one? And why am I looking at this one? Because this one here didn't do any kind of a short-term price run where it created a swing low like this one does here. It rallies up and then it overlaps that entire run and breaks it there on that candle. Once that occurs, as soon as that happens, I'm waiting for price to make a turn and start going back up. Well, what happens here? ICT didn't go above the equilibrium, price went here? No, because this level isn't the equilibrium until this low. So if we were looking at this here, did that trade meaningfully above the 50% level? No. And even if it poked its head above that, did it trade to a fair value gap that would be inside that price leg from here to here? No. So look closer. You have this price run down. We're waiting for price to go back above equilibrium, which is the 50% level on your fib. There's no mystery to it, okay? This is the only benefit of having a Fibonacci in my mind. That and how I use it for targeting. And I'll show you that stuff. And you've probably already seen many times me doing it in my live executions and managing the position, trailing the stop, looking for targets to be hit and such. But this run above equilibrium within this price leg here, that sets the stage. Okay, now we are in a premium market, meaning this range is premium. It's, in other words, overbought. I don't need an indicator. You don't need an indicator to derive that. From this point here to here, this is discount. As soon as we leave, and again, this is, not in the folks that try to teach my stuff. They don't know what they're doing. And I'm asking you, please stop trying to teach my stuff because you don't know what you're doing. You're not covering things that are most salient, and you're oblivious to the things that are necessary for certain things to be really in the marketplace. This discount, okay, in the red shaded area above this level here, that's a premium. Above it or at that level, they're your ideal shorts. As soon as you cross the midpoint of the discount level here, once we get through that, I did that by eyeball. That was pretty good, wasn't it? Once we get through that there, the highest form of profitable shorts, the highest probability short entries, they have now been exhausted. The only thing you want to be focusing on now is taking partials and trailing your stop. Yes, that's a diamond. You just simply can't just take every single trade and enter. When do I stop taking partials or pyramiding? Something like this. Now I'll build pyramiding entries all in this until we get through here, and then I stop taking pyramid entries. Go back and look at my examples and you'll see that's the truth. So when I wanted to learn how to pyramid and build my positions large, I learned it incorrectly from Ken Roberts' rag of a book, the world's most powerful money manual, of course. It's a long title for something that was useless, like toilet paper. But I guess toilet paper is useful, but use toilet paper, let's put it that way. The idea of looking for the best entry points, the highest probability, and how the market will respect those levels more so than others. See, once we leave the midpoint of that discount range of this price run here to here, and we're in the lower portion of it, we're entering that expansion phase. That expansion phase is likely to not offer very many, if at all, new high probability pyramid entries to add to a position. So there's a threshold at which I will no longer add to new existing positions. But while I'm in that premium area, within that price leg, within the market structure that I'm looking for, as I just outlined here, and again, you're going to want to watch this portion of the video several times, it gives you the highest degree of probability for delivery from your entry to your targets. And you don't want to chase the move and build in more position once it breaks through the threshold I just outlined here. Because to do so, number one, you're going to be worrying about trying to put on another position versus taking off some as it moves in your favor. It's crucial in the beginning for you to do those types of things. Now, for someone that's seasoned, they've been around for a long time, you know what you're doing, you know how to profit, you know how to look at targets, your targets are not unrealistic, and you can go to full terminus. That means your full target, where you aimed for when you first got on the trade. In the beginning, and this is who I'm talking to right now, when I'm doing these live streams and I'm talking to the students that are here listening, I'm not talking to the guy that's been doing it for 5 years and he's funded and he's got, profitability. You can glean what you want to glean from what I'm teaching. But it's the folks that are brand new. They have no idea where to go. They have no idea what to do with this information, how to use it, how to frame the logic. What rules do you follow? What do I do? What do I don't do? That's what I'm trying to accomplish with these lectures and obviously with the live streams. So once the market starts to draw back up into this premium area, we have to go through our time frames and look for fair value gaps. So right away we have this low to high. Let's go back in with the fib. So we have to go into a fair value gap at or above equilibrium. So from this point on up, we can look for what? A fair value gap. Is this a fair value gap? Yes. What if you sold short there? Would it be profitable? Yes. Where would your stop need to be? Here it needs to be at the high. That's a lot. That's a lot of range. But I don't want to have a stop loss like that. Okay, but you're going to have to be more selective with your entries then. Now look closer. Inside this price leg here, this is why I'm not supply and demand also. What is this? What's that? What's the separation between this candle's close and this candle's opening? Volume imbalance. The volume imbalance has no body between two close and or opening prices. So it can be a volume imbalance between a higher close and a lower opening, or it could be a difference between a close with a higher opening. That's the difference between the two potential volume imbalances. The wicks overlap. See how it has a small little wick right here? Let me see if I can. How can I do that here? I know there's probably a shortcut to do this, and you guys are saying, if you would just do this, ICT. There's a small little wick here and a small little wick right here. Whenever I'm looking at price, I'm looking for those types of things because that's a signature. That's a little glitch in the matrix. Think of it like that. So if you take that and draw it through, because we cut through candles, Sam. We're not supply and demand around here. If you cut through all this drop as it's retracing back up, what's it reaching for? It is reaching for an imbalance in here. Yes, there's one here with this candle. There's one here between this candle's low and this candle's high. And then we have one here to here, specifically with that candle. Which one is better? Yes, you can enter here and have a stop loss up here. But look closer. In this delivery higher, when it ran higher, what is this last up close candle anyway? It's a bearish order block. Why is it a bearish order block? Because it has a fair value gap. Opening price on this candle is what? You're going to look right here. Opening price on this candle is 4130.00. Okay. What's the high on this candle here? You're looking right here. The high of that candle is 4130.00. You cannot improve on perfection. That's algorithmic. What's the high on the next candle here? 4130.00. Again, not one tick off, not one tick over, not one tick short. So if you had a series of fair value gaps, which one do you look to trade to or use your entry at? Look for the bearish order block, look for a volume imbalance, or a fair value gap on the other side of the drop. You extend it through. Again, we cut through candles. You can't, I'm not trying to be so dogmatic in the live streams, and I'm trying to control myself because I will literally go into a Twitter rant and just not be as productive as I'm trying to be. There's certain things you have to look for. And I can't teach you every possible scenario that's available in the future because it's better to see it live, explaining it live. Then you're looking at this saying, well, that's not live. It already happened. I understand that. But I'm showing you the logic that one would use to get to the delivery on this setup, which is exactly out of the 2022 model that was shown to you last year. So with that volume imbalance and the fact that it's above equilibrium on that price leg right here. So the first one you can come to, you could go short there and your risk would be to that high. Trading at this one with the volume imbalance and the fair value gap, and now watch. What's the half of this up close candle? Remember what that was? What's the half of an order block? It's not consequent encroachment. Consequent encroachment is any inefficiency. A fair value gap, buy side imbalance, sell side inefficiency. Those are consequent encroachment midpoints. A candle, a range, a specific candle that's been delivered in price, the midpoint of that is mean threshold. Low to high is 41.31.5. So if you were taking this fair value gap, joining it with the volume imbalance, and it's a bearish order block, price should not do what? It should not trade above the midpoint of that up close candle. So your stop could be at 41.32. 41.32. So that means you have a 2-handle or 2-point stop loss entering within this volume imbalance, within this fair value gap. And if some of you are new, you have no idea that this stuff is repeating like this. And I walked you through an example, something like this in the stock indices last week. I said, I wanted to use a fair value gap for a resistance level. And it stopped dead in its tracks, just like this did here. And I executed on it, and I showed it to you. So it's not cherry picking. It's not looking at hindsight only. You have to study hindsight. Every trader that's making money right now, that's profitable, they learned by studying hindsight. You have to understand what the concept looks like. You have to identify it. And that way, by seeing it, like when you go out and you learn how to hunt and track your prey, you spend a lot of time looking at tracks. Oh, this is a bear, this is a elk, this is a deer. And that's the only way you can identify what it looks like, because you have to see it in the history. Where has it been shown before? But once you understand the basics of the pattern, the setups, the primary framework, then it must be studied on real-time data. And it doesn't mean studying by pushing a demo account or studying with a live account. You do not learn anything correctly by doing that. There's a step in between that everybody skips over because they're in a hurry to be profitable. Versus, I want to take my time and be systematic. I want to know that I'm doing what I'm supposed to be doing and avoiding the things and not being influenced emotionally and psychologically because of the money. Because as soon as you put a trade on, you're worrying about the P&L of that trade. You're not worrying about the price action. Your mind shifts from managing the risk and managing the trade versus, now I hope I don't lose. Is this thing going to turn around and go after my stop? And it may not even be close to your stop. But most of the time it will, because you're in a hurry to do what? Jam your stop loss up. And that's not what a profitable trader does. Profitable traders aren't in a hurry to race their stop loss to break even. They're not concerned about that. Why? Because they've been here before. They know that even if this trade fails, it's not going to end their career. It doesn't undo the efficacy of their model or their approach to trading. It just means that that was one human transaction that they made. They placed risk behind it, and it was wrong, and it didn't deliver a favorable outcome. But you can still learn from that. And it doesn't unsettle you as a profitable trader that you don't say, I'm going to change what I'm doing. I'm going to change my approach to trading because I had a losing trade. Now, in the beginning, that's exactly what you're going to want to do. As soon as you try to learn from me or learn from someone else and you suffer a losing trade, the first thing you're thinking is, okay, this doesn't work. Let me go to something else. And I did that. I did that for years. And I had a winning model, but I kept tinkering around with it until I realized I was holding myself back. So that's how we go through the process of looking for the right fair value gap. Now, if there's no volume imbalance, or if there's no fair value gap here on the other side of the displacement leg, then I'll use the first fair value gap above the equilibrium. And then there it is. Now, another version of this would be using this. And I usually do this if I'm going to be building a large position. Like if I know I'm going to be building a large pyramided position up, I'll use this run up where it takes, right before it drops down, it takes a shift in market structure. So this is the displacement leg. Okay. This leg here, you split that in half. You would use any fair value gap, any fair value gap at this level, and here's your sell side. Look what we just talked about there. Let me finish this thought here, and then I'm going to talk about this volume imbalance I mentioned. This leg here to here, if we had no volume imbalance, if that wasn't there, I would take this low to that high, the equilibrium there, drag that through. This would be the fair value gap at that moment. So then I would be doing this. Again, this is assuming that there's no volume imbalance. My entry would be here and framed on this fair value gap there.